The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Brent in Martinez, California. Hey, Brent, what's going on?
How you doing today, Tom?
I'm doing great, man. You having a good day out there?
I am, thank you. I was really just commenting on the fact that I'm really enjoying the new format with you being there when the market's still open. You've assembled a great group of people. They're all great technicians. And I'm so glad that I first caught you on the radio with your little tiger growl. I'm like, who is this guy? And it got my attention, and it's really made a positive change in my life.
You're awesome, man. Thank you so much.
Now, Tom O'Brien.
Welcome, folks. This is Tom O'Brien of TFNN. We appreciate you growling and prowling with us out here, folks. We have a special program for you today. What I am going to do, I'm going to go over where the markets are now, where I think they're going to be in the coming months. We're going to go through the S&P, the Dow, the NASDAQ, oil, gold. Be strong. Go with your heart and believe in miracles, because anything can and will happen. Okay, so right now, Dow Industrial is 17,546. NASDAQ is 5,035. S&Ps are 2,058. We have gold at 1068. Silver's at 1428. Oil is trading out at 37.45. What we're going to do first is that we're going to go through the S&P. Since the S&P 500, we'll take a look at the SPY. Where the SPY is trading right now, the SPY is at $205.49. And we're going to look at this on a long-term basis so you can see where we are, where I think we're going to be, and just what has happened out here in the past year. So thus far, markets are flat for the year. That being said, what you're going to see is that this market, when we came down in August, was a break, and a serious break, of the uptrend. And what I'm talking about is this, is that when the market started off in 2011, the SPY, the SPY, the low of 2011 was $110. We go all the way up and we get into the price point of $213. Huge expansion on the way up. And then what ends up happening? Well, when you break a trend line with wide price spread, accelerated volume, and have zero volume at the highs, light volume at the highs, which is distribution, bottom line is that you start making your way down to the lower part of the trend line. Now, if you're watching Tiger TV, what you're going to see is that when we broke that downtrend, that uptrend rather, and we did it in August, it was with conviction. You know, we were making highs out here for 8 months on dramatically lighter volume. We were making, the first high that was generated was December of last year. That was generated with 3 billion shares. In January, in February rather, we did 1.9 billion. March, you did 2.7. We go over to May, we did 1.8. Stayed up there. In June, we did 2.5. It stopped moving lower. In July, we did 2.4, and ba-boom. You broke the uptrend with 3.7 billion shares. You come down with monster volume. Now, what does that set up? Well, what it sets up is that when you break that trend, number one, you're going to go to the bottom of the trend. Number two, you're going to go to the last place where we had any volume. Where we had any volume is that you have to come back over, and you come back to the 2008 level, which is 129. That'll be a 1290 S&P. Now, to show you the correlations on this, I'm going to take this back, and I'm going to bring it back actually 20 years. Now, the reason I'm going to bring it back 20 years is this, is that what you're going to see is that when we broke the trend in 2007, when you do price and volume, folks, it's robust whether you're going up or you're going down. So bottom line, it has to do the same thing whether you're going up or going down. And what you're seeing here in 2007, if we take a look at this in the start of 2003, we're at $76. We get up to $156. We base out at the highs for 8 months. you break with volume on the way down. And what we did have in 2007, which was pretty cool actually, is that the first break came in August of 07. You broke down with volume. We had made a high out there with 3.5 billion shares. And then we tested, the high was 3.9 billion in July of 07. We broke down, and we broke down with 2.6 billion. That was the first initial break. We go back higher. This was about as deviant as it can get, but it was pretty cool because what happens is this: you go down to 137 on the SPY. You go higher the next month with 2.9 billion after you already broke down with 6.2. You go to a higher high with 3.5, and then it just let loose. Then what ends up happening, you come down, and we come down with 6.1 billion shares, coming back into test the lows that were established in August. And from that point on, what do you end up doing? You end up going back to the beginning of the trend, and in this case, it was a disaster, of course, because the beginning of the trend was $88, and we ended up going to 66, I believe. Yeah, $67. So the correlation, if we bring this back and you take a look at this again, what you're going to see is that that was a decisive break in the trend when we broke down this past August. And we haven't got above that. In fact, when you look at the channel line, we haven't even got to the top of the channel line. The top of the channel line could get you back to 224, but we're not even close to that. You broke down on the 3.7 billion shares, and we did 1.9 billion last month. That is the SPY. If we go into the Dow Industrials, we take a look at the Dow. What you're going to see inside the Dow, we're going to set this up. First, we're going to set it up on where we are right now. And what you're going to see inside the Dow Industrials is the same type of setup. And the trend that we're talking about that we broke is the trend that started in October of 2011. So in the Dow Industrials, the bottom of that was 10,404. The top of that beginning is 12,284. What do? Same type of setup. When you came, we're at the highs, distribution dramatically lighter volume at the highs. You broke down, and we broke down. The Dow Industrials were making highs at 1.8 billion, 2.1 billion. That's actually more than that. It's, let's see, 1 billion is 31 billion. That's 24 billion. 24 billion, 18 billion. We made a high with 18 billion. We were up there for 6 months. We came off that, and then we came off that with monster volume on the way down. We came down with 27 billion. Same type of setup. If we take a look at the diamonds, the DIA, what you're going to see, the diamonds, which is the ETF structure inside the Dow Industrials, what you're going to see is the same type of setup. That setup, you had a decisive break. You made highs out there with 84 million on the monthly. You broke down with 209 million. You test in that area. We tested it last month with 104 million. You stay right there, folks. We're going to be coming right back. We're going to do the NDX 100. We're going to do the transports. We're going to do the small caps. Be right back.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Are China A-shares hot or not? If you trade China A-shares, now may be time to take a closer look. Trade CHAU or CHAD, Directions Daily CSI 300 China A-share Bull and Bear ETFs. China A-shares in either direction. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. We are going over where the markets are now, where I expect them they're going to be in the next few months. If we take a look at the NDX 100, what do we have with the NDX 100? So the 3 Qs have been on a run. If we take a look at this going back to 2011, they started out at $49.88. Straight line move up into the $114 level. That being said, what you do have inside this is the same type of setup, that the uptrend in August was taken out with conviction. And now this is what the difference is inside the Qs. It was taken out with conviction. You go down to 84. You do 1 billion shares. Well, it's actually more than 1 billion. So the Qs every day are doing on the monthly basis 2, 3. So this decimal point. Well, 15 million. No, okay, yeah, no, 1 billion shares. You come off that area, and you hitting highs with 645 million. You come off that area with over 1 billion. You test last month, and you go back up with 543 million. And what you're going to see is that if, in fact, it can get up and over the 114, yeah, you can go higher. Thus far, what this has done is that it's banging right against the channel line as it broke, and would have to get up to approximately 119. We take a look at the transports. So inside the Dow Industrials, we take a look at the transports. Now, the transports, folks, have made their high in November of 2014. So the high that was generated in the transports is 9,300. Right now, you're at 7,610. We put the transports first on a 10-year monthly, and what you're going to see is that when that trend got broken, it got broken with conviction. We made highs inside those transports, you made highs inside those transports. Let's see, November, we had 276 million shares traded. You go sideways for 6 months. When it will go south, we end up doing 337 million shares, 380 million shares, and now it is so thus far we're down at 8,076, 357 million, and what's happening with the transports is that the volume is actually expanding. Now, what does that say? Well, that's saying that, number one, the transports, I suspect, want to get back into about 5,200, which is pretty intense. That is a long way down, number one. If we take this and we put this back to 2007, what you're going to see is the same type of setup. All of these you can actually bring back, and if you're looking about how you break something with conviction, you can bring them back to the 2007 area, and you'll see that the extension on the way up was nice. The distribution at the highs was dramatically lighter volume, and what you'll see is that the way down, volume blows out of the market. In 2007, the transports had made a high of 54.87. That was in July. We did that with 610 million. You come down, and that was the first one with the warning shot, 732 million in August. We make a lower low in January with 765 million. Now check this out, because this is pretty wild what the transports did. The transports end up going in January of 08 and from $4,000 price point and got all the way back up to 5,300. Now the 5,300 area, all that was doing was going at the bottom, testing the bottom of the trend break. So that channel line was laid out at that number. It went up to it. It did it with 478 million versus the 610 million from the first high. And the correlation here, so there's your test of the high after you already had your downdraft of 765 million. What does it do? Blows apart again. You come off that high. We come off the high. We do 682 million, 600 million, 680 million. And bottom line is that what do? You make your way back to the bottom of that trend. That is a huge heads up as to where we are in the marketplace right now, meaning distribution, and where I expect you're going to see this market make its way down to. The IWM, small caps. Now, the small caps also, right now we're at, on the IWM, we're at 114. 129 is the high of the small caps. That was established in June. We take this back first. We put this on a 10-year, and what you're going to see on the 10-year, you're going to see on the 10-year that we broke with conviction. First we did a high, and where I'm going with this also is the October 2011 is your benchmark, because that's where this particular trend started. The larger trend started in March of 09, and that's a whole different ball game. I don't expect we're going to run all the way down there. That particular trend, the market would have to, well, if the market goes where I'm thinking it's going to go into the 011 highs, then there would be a problem, because what would end up happening is that the trend line that you'd have to make coming off of the lows of 09 would bounced off those a few times. But bottom line, in 2011, that's a steep decline as it is. So IWM, what has the IWM done? You got to highs, and on a monthly basis, we did 670 million. That was the high that was established in June of 2015. We come down the first month with 683 million. We broke the trend with 871. You followed lower with 770, lower with 800. We bounced last month with 580. The correlation, folks, of breaking a trend with wide price spread and conviction, that's my definition of a break, and then you go back up and test it with lighter volume, there is your confirmation that your probability goes dramatically higher, that you're going to come back down the other side, bust out the lows. The October 2014 lows, they had been hanging out there for a long period of time. In fact, they were hanging out there from October all the way to August, and they haven't been hit yet. So that high volume low in the IWM was 103.54. We got down to 106.99. You stay right there, folks. We're going to be coming right back.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Welcome back, folks. We do appreciate you growling and prowling with us out here. Next, let's go to the XLE. We know that the oil market has got hit, no doubt about that. In fact, we'll do oil first. So when we're taking a look at the oil market here, we are at $37.46 on the continuous contract. We'll pull this back. And what you're going to see is that the oil market peaked out in 2008. The high of 2008, July of 2008, hard to believe right now, $147.27. Goes straight down. You know, you're talking about we went from July, it only took to December to get to $32.40. Now, what ended up happening inside the oil market? We pull this back, and what you're going to see is that oil stayed at highs for quite a while. You know, when we're looking at the oil market, the highs that we're talking about, $114, that was established in March of 2011. We went all the way over to June of 2014. And, you know, you had slightly lower highs, but bottom line, big numbers. Big numbers that stayed at big numbers. Then what ended up happening? Well, you come off those highs with monster volume. 4 months straight down, 3 months, no, the 6 months sideways. Now what are you doing? Well, we're right next to the low, so your probability that you're going to hit this low is pretty good. And the low that we're talking about is $32.40. This month we've hit $33.98. In order for oil to really get going, it would have to get back inside the $46 area, the $43.58. Where I'm going with that, folks, that was the lows that were established in January of this year. Okay, so now that being said, you know, we'll see how it attacks this $32.40. If we go to the XLE, which inside the XLE, of course, is that you have the large oil companies. ExxonMobil is 18% of it. Chevron's 14% of it. You have Schlumberger, which is 7%. Valero, 4%. Then you have EOG, Oxy, ConocoPhillips, Pioneer, Treso, and Phillips. Inside this XLE, this is also setting up for lower price. And the XLE has already come down pretty dramatically. So first, what do we have? Well, if you go back to, on this one here, I'm going to bring you back to 2007 first, so you can see the correlation of, because all these correlations are robust. You can look at them both ways. And 2007, what ends up happening, same type of setup, beautiful trend on the way up. That trend goes from a price point, if we look at 2005, the XLE is trading at $37 to $41. Excuse me. Goes, excuse me, folks. Goes all the way up to May of 2008, hits $91. We do 560 million shares. In June, we do 638 million shares. In July, we do 800 million shares. Then what ends up happening? It's actually July that it didn't get to a higher high. The high in July was $90. The low was 71. You had the expansion of volume as you actually broke the trend. So we break the trend. We break it with 850 million versus the high of 566. Then what ends up happening? You go sideways for a month. We do 700 million. The following month, you do 1 billion shares. You get down to a price point of 63. Next month, you do 1.3 billion. You get down to 51. You actually come right back to where the trend started in 2005. So what ended up happening, unfortunately, is that it was May of 2005, got to a high in May of 2008. So it took 3 years to get up there, and it took 5 months to get back. Okay, so now where are we right now? Well, what you're going to see right now is that the run that we had inside the XLE, you know, we're off the highs. The high in the XLE was established in June of 2014. That's 101. We're already down 40% off of that. That being said, what you also have is that the break inside the XLE also was with conviction. Now, this is going to be intense because the difference of the XLE versus the S&P and versus the Dow is that the XLE has the trend line that it's broken is from the lows of 2009. The trend lines that we were talking about thus far in the S&P and the transports and the Qs was the trend line from 2011. So what does that set up? Okay, so what it sets up is this. We go from a price point of $37.40 as that low. You get up to 101. Now, it absolutely is anemic in the XLE how we're up there. So watch this. This is like crazy. 181 million on a monthly basis was made the high in June. In July, going sideways, you did 185 million. In August, you did 185 million. And watch how this gets subtle now. In September, you start going down. You went from 98 to 90. You had the expansion. You did 262 million. Now, this is the kicker. When it decided that it wanted to break the trend line, and this is what normally happens, folks, a break of a trend line, in my definition, with conviction, has to be with wide price spread and accelerated volume. And it's like you don't even know how this really happens. But bottom line is that the market itself was expanding volume on the way down. Then the volume just blew out of the... When we broke that trend line, we went from the prior month of 262 million, and we did 769 million. You go sideways again with 420. You break down again with 782. So what does that set up? Well, this sets up two different things, meaning because now it's one thing knowing that you broke a trend. Another aspect is, okay, where are we going? Well, what has happened inside the XLE is that the first low that was established inside the XLE was August. We got to $58.74. You did 486 million shares. We've already done 477 million shares, and we've got to 58.21. So what that is saying is that, number one, it's not out of the woods, because that means your volume is going to be higher this month, even with the vacations and with all the rest of it. So when I'm looking at this, it looks to me that, what it probably is game here is somewhere around $50. 53's, 50, 58's to the lows right now, about 50, and where I'm going with that, those were the highs of the lows that were established when the XLE was bouncing at the bottom. Because what the XLE had done is in 08, it was down at those lows for 5 months, consolidating. It had put in the low, but it was testing those lows, and it was testing those lows with lighter volume. You stay right there, folks. We're going to be coming right back. We're going to be doing the gold market, silver market. We're going to be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Tom O'Brien.
Welcome back, folks. Now, let's go over to the gold market. So we know the highs in gold were established in 2011. Right now, you're trading at 1069. We bring this back. First, we'll put it on a 15-year basis so you can see where that run was. In the continuous contract, the high in gold, folks, was 1920. You come off 1920, stayed at between 1920 and 1500 for approximately from August of 2011 going all the way over to February of 2013. And then what does it do? Bottom line, does the same thing, breaks down with volume, by the way. That break, the severe break, was in April of 2013. Now, where's it going back to? Now, this is the gold market. It's really wild how this is playing out right now, and this is what it is. In November of 2009, that's when the leg up that basically took it right to the highs started. And you talk about taking out swing points. So when you look at gold from March of 2008 over to September of 2009, you were in a consolidation. In the downdraft of 2008, gold went from 11, I believe it was 10, this contract went from 1033 to 681. The actual contract went from 1033 to 666. Because the continuous contract is a little bit different. Bottom line, it went down to 681. So you didn't break out of the highs until November of 2009. Now, that November of 2009 level, this is right what we're banging on right now. The low of that breakout is 1,042. As we're coming down into this, now if I take a look at the G, I'm going to put the GLD up so that everyone can do this over the weekend, do it in the vacation, whatever you'd like to do it on. The GLD, what you're going to see, because what happens with the GLD also is that it trades at 10% of the price of gold. Now, what does happen with the GLD, when you're looking at the GLD on a chart, what you have to absolutely understand is this. The GLD has an expense ratio of 0.4% per year. So what that means is that every year, the longer that this trades, the longer that the GLD wouldn't have a direct correlation of 10% of the price of gold. Because right now the price of gold is 1,068, the GLD is 102. If it was trading the same, the GLD would be 106. So you can get the gist of it. And the GLD, wasn't always out there. When the GLD started, I think it was in 2002, it was after the gold market started moving that the GLD came into existence as an ETF. Okay, so when we're looking at the GLD as to where we are right now, what you're going to see, we were talking about, last Friday, And last Friday, we'd be talking about, let's see, with the 21st, approximately the 17th or 18th of December. The gold contract, the metals in general, had the chance to jump off the cliff. The Federal Reserve came out. They raised rates first time in 9 years. They're looking, they're going to raise them more. Bottom line, what ended up happening out here is that the GLD decided not to jump off the cliff. On Thursday, they come out with it on Wednesday. Bottom line, Wednesday, the gold market went up. Thursday, trashed the gold market. And you had on the daily, you had an expansion of volume as they trashed it. Friday, just the opposite. Where it could have dove off the cliff, it decided not to. Okay, so that's the short-term view. Short-term view, GLD is at 102 and looks to me like it wants to run to 104.21. The longer-term view, though, if you own gold or you're in this market, is looking at this, and it's coming into the November area, and we're talking about dramatically lighter volume. Now, when we went topside and the gold contract in November, the GLD ended up doing 403 million shares. GLD traded from 103 to 116. Following month, it went to a higher high with 570 million shares. We've been trying to break into those lows, and we've been trying to do that now since July of this year. July of this year, we came down at 157 million. Of course, we're going into 403. In August, we came down with 151 million, breaking into the same number. Last month, we came down with 106 million. Now this is where this is going to get really interesting. So your correlation goes like this. Pushed down last month, 106 million. July and August, you had 151 million. You're going into 403. Now, it's just not that level there that gold has some heavy support. And this is why. Because when we had gone topside and to try to break out the first time in February of 09, you had 504 million. So this area right here is crucial for bears and for bulls. Number one, you want the area to hold, and number two, what you want to see is that you want to see this come off this area with wide price spread and with strength. On the daily, we've had that. On the weekly, we have not had that yet. We will see at the end of this month. I don't expect you're going to have it this month because as I'm doing this on the 22nd, 23rd of December, bottom line is that this month is just about over. What we do have this month, however, is that you have a rejection thus far of lower price. You have lighter volume. And now what you need to do is that you got to see that strength. Now, I expect you're going to get that strength. And the reason being is that the longer that you try to break down lows, and we've been there 5 months right now, and the contraction of volume gets as dramatic as it has, meaning not going against what you're going against, you're going against the last July and August time frame, that is saying that the sellers are done. Now what it takes is that you need buyers in the market. The first real bounce that I expect that you'll get out of this is that you'll get up to about the 130 area. And where I'm going with the 130 area, folks, is that on the way down, from April of 2013 rather, that was the last time that you had any real volume on the way down. And when you get bounces that come out of the marketplace, that is how markets like to bounce when they start bouncing. If we go over and we take a look at the one of the premier stocks inside the gold market, Randgold Resources, what you're going to see with Randgold Resources, we put this on the same type of 10-year basis. What you're going to see, Randgold, the high in Randgold is $127. It's a $62 stock right now. It's coming into the exact same, well, it's actually not the exact same. It's a breakout area. It's May of 09. that has 30 million shares, and that's been bouncing along, testing that area with 20 million shares, with 15 million shares. You stay right there, folks. We're going to be coming right back to wrap it up.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Welcome back, folks. Okay, so this is the first time in 9 years that the Federal Reserve has raised rates. So, have to go over to the bond market, take a look at the bond market, where we are in bonds right now. The deviation inside this bond market and the deviance inside this bond market is pretty intense right now. And what it is specifically is this. We're at 154.07 in the 30-year bond. Well, the high in the 30-year bond, the closing high in the 30-year bond is 160.29. You have 30 ticks inside it. Bottom line, we're right next to these highs. That being said, this is what you have. We take a look at this on a long-term basis, and what you're going to see is that the bond market at these levels the retracement is so weak, it's amazing, actually. When you go back to January of 2014, the 30-year was at 127. It runs all the way up to 166. 166 was the high in April of this year. It comes down hard. It comes down from 166 to 147 in June and in July. It goes topside again. Now, when you look at that and you put that in perspective, however, that retracement, folks, that's all it is thus far. That retracement is a very shallow retracement. The bond market itself, that was a 50% retracement of the move that started in 2013. And the way that this looks that it's set up is that we're going to continue to have lower rates. It's going to be very hard for the bond market to not only break into lower prices. Thus far, it's in a whole different trading range and has been in a higher trading range since it broke topside with that wide price spread bar in March. So the bond market first, the 30-year bond market has to get under approximately 151 in order to get the lower price. Now, it will break that into the TLT, which is the 20-plus bond fund. What you're going to see is that this, on a monthly basis, also broke topside. It absolutely doesn't have to go back to its highs. The highs out there is 138. You're at 121. But what you're going to see is that there's no sellers. You know, when this went topside in 2011, we got to $112, and you have 489 million shares traded there. The following month, you get to 123, and you have 269 million shares. Well, when we're backing down, we've been backing down with 200 million shares and 123 million shares last month. 123 million shares when you're backing down last month means there's no sellers. This month, we went higher, and this month is, of course, a weaker volume month. You went higher with 160 million. So even though we have a weaker volume month because of the holidays, we already have more volume on the way up than we did on the way down last month. Bottom line, you can go over these markets. You can take a look at the trend line, take a look at the break, take a look at the wide price spread, take a look at all of the above. We do appreciate you growling and prowling with us right here at TFNN. We look forward to a great holiday, a great new year with all you tigers and tigresses. And if you do enjoy the program and enjoy TFNN, folks, with all the talk hosts, please tell 3 people. Remember, we start programming at 8 o'clock in the morning, go to 6 o'clock in the afternoon, Tuesdays, Thursdays, 8 o'clock in the morning to 5 o'clock in the afternoon, Monday, Wednesday, and Friday. Always remember, whatever you think about, you bring about. Whatever you focus on grows. And whatever you want in life, folks, visualize it like a nice big motion picture. Step into it, take ownership of it, and fly with it. Thanks for being here, folks. Have a healthy, happy, prosperous new year. Yesterday's gone. Tomorrow's not here. What are you doing right now? Go get 'em, folks.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
This is TFNN.